Hello and welcome to today's webinar. Our title is Succession Planning and Selling Family and Closely Held Businesses. I'm Rob Wellendorf. I'll be your moderator for today. Thanks so much for joining us. As we believe in collaboration being an essential part of success in our profession, I'll mention today's webinar is co-sponsored. Both the Society of Financial Service Professionals and the National Association of Estate Planners and Counsels. Very proud to sponsor today, and again, appreciate your attendance. A couple of housekeeping items as we get started. First, the webinar is indeed being recorded. All of the registrants will be emailed a link to the recording in about a week. Also, there's a PDF copy of the PowerPoint presentation. Not only was it sent to you with your confirmation link, it also can be accessed in the tab where you can click on handouts to bring it up. Regarding continuing education for our presentation today, the credits that are available, we have one professional recertification credit. We have one CPE credit for our accountants and one CFP credit. If you requested credits when you registered, the certification of completion will be emailed out to you in about a week. For the accounting credit, be sure to make note there'll be 3 CPE participation codes throughout the presentation. Again, when they appear, please make note there'll be 3, and those will need to be entered at the end of the presentation on the evaluation form. Once again, that is for our accountants only. As far as questions, go ahead and submit them again through the box button on your computer screen. Those questions will be received and batched, and I will present those to our speaker at the end of the program. And with that being said, let me introduce our speaker for today, Jim Aussem, JD AEP. Jim is a shareholder in the Cleveland law firm of Cavitch Familo Durkin. He's a former member of its board of directors, a former chair of the business practice group. Jim's practice focuses on succession planning, mergers and acquisitions, as well as estates and trusts. Jim is a frequent speaker, facilitator, and instructor for many professional organizations. And again, his topics of expertise: business succession, buying and selling businesses, estate planning, insurance, trusts, and estates. We're very happy to have Jim today. I'll hand it over to you.
Rob, thanks very much. It's a pleasure to be speaking to 2 organizations I care a great deal about, FSP and NAPEC. I'm happy that we have so many participants. Whether you're a part of NAPEC or FSP, you are welcome, and we're glad to be involved. This is my favorite topic, and it's my favorite, I suppose, because it's what I do for a living. I deal with closely held business owners. Quite often, those closely held business owners are family members, but they don't have to be. And the family dynamic adds another element to it. And so what I'm going to try to walk you through today in some 50 minutes, kind of leave some 10 minutes or so at the end for questions, is how I approach a closely held business owner or owners in terms of doing a succession plan. And hopefully you can use this in your practices. And I start out with suggesting to the owner, you've got 3 options. You can die with it. And if you die with it, it's your family's problem, because what happens is when you die in the saddle, you've either stayed too long or you've died because there was a sudden illness and you did not have time to complete your planning. The problem becomes, and you see it as a practical matter, and you can use this with your clients because they like practical analogies. Where do you get bargains? You get bargains at estate sales. So if somebody dies running their business and there's no succession plan in place, that becomes a potential problem for your family, because you are unlikely to get the total value you might otherwise get from that enterprise had you done some succession planning. So that's a key factor to open your client's eyes and say, why do I need to do this? Well, that's probably the biggest reason you need to do it. Because sort of like Live Golf Tournament and PGA, for those of you who pay any attention to that stuff, it's always about what? It's about the money. The more money your business is worth, the more value you can extrapolate from that business and take care of your family. You'll be accomplishing your purpose. That's what succession planning is to some degree. And if you don't have a plan, you're likely to get less money, period. Pass it on. You can pass it on. Usually passing it on means it could be an employee stock ownership plan, which is a whole nother topic. We're not going to drill down and get involved with that today. Or to your family or members of your family who should take it on, because members of your family who are not going to participate in the business probably should not be owners, and or key employees or your co-owners if you're not in a family business. And that becomes everybody's problem. It becomes everybody's problem. Again, this is an emphasis to your clients, because if the business does not successfully operate after you pass it on, whether to your family, to your co-owners, to your family and perhaps key employees, or even to an employee stock ownership plan, if the business doesn't succeed, you're not going to get your money out of it. Your family's not going to continue. And a family business that fails is a monumental problem for everybody at many, many levels. And if you determine, you as the owner or your client as the owner and you as the facilitator, the trusted advisor, that passing it on is probably not going to work, and we'll get into that today at some length, and you can always sell it. That is sometimes a very good and practical option. So sit back, think about it with your clients, and start with this discussion. There's only three options. They're going to either die owning it, they're going to pass it on, or they're going to sell it. There's another option. Let me know. Now, I think a family business certainly defines who we are. It's our lifestyle, it's our family's lifestyle. If I asked you to, if we were in a live meeting, to go around the room and explain to me what you are, who you are, and what you're about, without saying what you did for a living, that becomes a very difficult proposition. Because we define ourselves by what we do, like it or not, that's how we do it. And that business that you or your client owns is their retirement, their security. It provides them, affords them the lifestyle they need. And it has to remain healthy. That's why succession planning is such an integral part of successful businesses. And ultimately, you have satisfaction. Many people on this webinar today are in this industry, which means in some measure, an awful lot of you, like myself, like Rob, are self-employed. So you get satisfaction being self-employed, but you have a bit of a risk associated with being self-employed. And ultimately, some of you may be like Rob, not me, of course, but like Rob, you simply can't work for anyone else, so you have to work for yourself. I'm kidding you, Rob, one of my friends. The other way to approach this with your clients is the three whats. And this is, again, easy for your clients to wrap their minds around. And it's not technical. And I'm not going to do many technical things today because I don't think that is particularly effective with clients. So I'm not going to do it with you because we're not going to get into specific techniques such as intentional defective trust, state freeze techniques. That's not what this session is about. If you signed up for that, I apologize. We could do that in another session at some other time. But the first what is, what does your client, the owner of the business, need from the business on a going forward basis? If most of your clients are like mine, the business has been their source of wealth, lifestyle, paying the bills for the last 30, 40, 50 years. They've not necessarily accumulated a lot of liquid wealth outside of the business. So if the business doesn't continue, they have a problem. So you need to figure out what they need. Do they need cash flow? Probably. Do they need health insurance? Are you transferring the business and taking them off the payroll, and now all of a sudden they don't have health insurance? There's some gap between the date they move off the payroll and the date they can go on Medicare. You have to think these things through, help them with that. Then you have to talk about what the business can afford. You have to marry those two. And then ultimately, what is the business worth? And we'll get into those things. So step one is, how much cash do they need? Do they want to continue to have their car and their car insurance and their car expenses all run through the business? Very common, okay? And most clients, perhaps yours as well, have most of their wealth tied up in their business, so therefore the business has to continue in some fashion. What can the business afford? That's critical for the reasons we had talked about before. If the business does not survive, then the family who is benefiting from the business will not survive vis-a-vis their capital requirements. And the capital requirements I'm referencing in this slide, however, deal with the capital requirements of the business. This is a mini business plan step 2, because if the business does not remain viable, does not continue to improve, there's going to be a problem. And let me give you an example of what step 2 is so important for. If I have 3 children, if all of my children continue to live in my house for the rest of their lives, okay, my business will afford them a very good living because you only have one house and we've got one common expense. But you know what kids do? They go out and they get married. They have kids of their own. And all of a sudden now they want to continue to work in the business. They want to kind of live the way they lived when they lived in the family's house. So what does that mean? Well, assuming the senior generation doesn't want to lower their lifestyle and the younger generation wants to raise their lifestyle to that of their parents, that business has to grow. And if that business doesn't grow, then you're simply taking smaller slices of a pie. So if the pie doesn't grow, what does it do? It shrinks. And I tell clients, business is either growing or it's shrinking. There's no real status quo. Tax implications, clearly there are tax implications. We're not going to spend a lot of time on this, but understand that in a business succession plan wherein the next generation family members are buying out their parents, the only mechanism to generate the revenue to buy out the parents is the business itself. Therefore, if money comes out of the business, the second generation pays tax on it, then hands it back to their parents. That has lots of tax implications and may not be the most effective way to leverage the buyout requirements. We need to think that through as part of the planning. That's why, as Rob mentioned, collaborative planning is essential in this industry, whether it be the attorney, CPA, financial planner, CFP, insurance professional, trust officer, etc. Nobody's got a monopoly on good ideas, so get everybody involved. Step 3 is what's it worth? And one of the things you have to do is probably have a formal appraisal done. And a formal appraisal is essential because you can't go to the Wall Street Journal and look up what the value of a closely held business is. So you have to have an expert who understands the industries, the surrounding circumstances of that industry, the current economy. Are they a growing company? Are they a shrinking company? What's the status of their equipment, customer base, etc., to put a price tag on it. Once you have a price tag, then you can do some planning. You can figure out, can we freeze the value? Do we need to freeze the value? Is the estate tax exemption going to change at 26? There's a lot of factors that could impact that decision-making process. But one of the starting points is, what's it worth? And then the parenthetical there is, what is fair? Again, let me use my own family. I have 3 kids. And let's say the oldest one has been in the family business now for 20 years, and the other 2 are not in the business. And the valuation that comes in from the expert says, my business is worth $7 million. And I have determined by the first step, how much do I need and my wife need to continue to live the way we want to live? We need to sell the business for about $4 million. So we need to realize $4 million from a business that's worth $7 million. So if I devise some mechanism to transfer my business to my oldest son who's in the business for $4 million over time, then what have I left on the table vis-a-vis his siblings? Well, clearly $3 million. And they're going to say, Dad, that's not fair. If you were to sell the business, we would share in the $7 million of inheritance. But if you sell it to our brother for $4 million, we're losing out on $3 million and he's benefiting. What does their sibling say? Their sibling says, Dad, I came into the business 20 years ago. The business was worth $2 million, maybe. I've helped you grow it. And you can say in the last 10 years, perhaps I've been the driving force to get it to $7 million. Why do I have to pay my brother and sister an additional $3 million? That's where you get into the psychology of this. This is not about numbers and law. This is about finding a commonality among the family members and successors to make the transaction work. So that's really important. And one of the things we suggest that give the members of the family who are active in the business, or sell it to them at whatever price you need to sell it to them to accomplish your purposes. And then give the other members of the family who would theoretically not be getting that bargain element of a family business, other assets. Life insurance, parked in an irrevocable life insurance trust. Maybe the business real estate, it'll be leased back to the operating company. Maybe it's the 401k. Maybe it's the stock portfolio. But balance it fairly, but don't give them an interest in the business, because if they become owners of the business, but they're not active in the business, what have you done? You have simply lit a candle, a fire. It's going to explode at some point in time, because that senior generation is now out. The next generation don't like each other because the son or daughter who's taken over the business, it's counterintuitive. The more successful they are with the business to make sure the senior generation gets paid, the more expensive it makes it for them to buy out their siblings. Their siblings are not an owner of the business. That's off the table. If they're an owner of the business, now you've got a problem, and it's counterintuitive, and it's in the way. Sweat equity, keeping children in the business, creating natural conflicts. Those are the things I just explained to you. And step 3, again, that being fair means giving the members of the family who are not active in the business alternative assets, not an interest in the operating enterprise. Okay, I've gotten to a point in my seminar today where participation code number 1 is succession. And so those of you, I guess just the CPAs, according to Shannon, are keeping track. Participation code number 1 is succession. All right, family business. This is where it gets really interesting. And I ask clients or audience members in my live presentations, how many of you are willing to admit you like some of your kids better than others? I always kid them. And of course, I always say, I like my daughter better because she gave me 2 grandkids and the other 2 didn't. And everybody gets a laugh out of that. And I hope you did as well. But the point is, parents feel compelled with their attorney, their CPA, their financial planner to make this plan and then tell the kids, this is what you're going to do. That doesn't work very well. And quite often the parents' concept, at least one of them, and quite often it's the female, wants to make sure everybody is treated completely, absolutely, unequivocally equal. In this practice, equality, which is based on mathematical certainty, can't be achieved. You have to achieve or strive to achieve fairness. What is fair? And the way to begin that process, and I've had some significant success with this, is what I call bottom-up planning. And bottom-up planning makes sure that the children participate in the planning process. It's not pushed down their throat. They sit down with a facilitator. Perhaps that facilitator could be you or somebody that you work with to help them figure out what they're going to do with the family business and how it's going to work. Again, this is the identified successors of the family enterprise, or the identified successors of an enterprise of 2 owners who are not related to each other, but who both want to bring in their kids. And that's really a challenge. These are the things that you would help facilitate with that next generation. Who's going to be the president? How are we going to wear titles? How are we going to compensate each other? If the president's making X, should the next layer be 80% of X? So if the president gives himself or herself a raise, then there has to be a raise for the next group below them, so they move in tandem? I don't know. Who's got authority to hire and fire people? Who's got authority to potentially sell the business? Should there be authority that's granted for the day-to-day operation of the business, and then special authority, supermajority issues for the sale of the business, the financing of the business, the termination of a shareholder who may not be pulling their weight? How do you resolve conflict? How much are you going to own? And if I'm going to be running the business on a day-to-day basis and you're going to be a passive shareholder, maybe your stock should be non-voting stock so I can run the business. And you eventually, because mom wanted to make sure you were taken care of, you'll benefit from what I do, but you're not going to have any say in how I do it. Lots of things that go into this discussion. And what I have found, hopefully you will find as well as a facilitator, that they will sometimes tell me things that they would never share with their siblings and never tell their parents, because that creates so many hard feelings and it's so touchy, and they really can't confide that they think their brother or sister or their brother-in-law shouldn't be a part of this for whatever reason. And I urge people, and I did this recently at a lunch meeting with somebody who's going to do this in Chicago, meet with the identified successors separately to get a good feel for how this is going to play out, what their thinking is. And I'll tell you a quick story. I was doing a merger of a Detroit company, a Chicago company, a Cleveland company, and a Meadville, Pennsylvania company. And it was appliance parts sales and repair and maintenance. And obviously that market was shrinking because people don't repair appliances nowadays, they get new ones. And these four owners knew that they had problems. So their concept was, we're not in geographic territory where we compete. So if we put our top lines together, we can eliminate redundancies, more money to the bottom line. Classic merger concept on paper. When I sat down with the son of the Cleveland owner, I said, what role do you see yourself playing in the merger? He said, I hope none. I hate the business. I only came into it because it was always assumed that I would take over the family business. When I met with his father and I told his father that, his father said, are you kidding? I hate it too. I only kept it for him. See what I'm saying? They were so sensitive about disappointing the other person, they could not be candid about the fact that they didn't want any part of this. Obviously, what they did was they sold out, did the other three. That's what they wanted. The advantage of this bottom-up planning, as I describe it, is that it builds consensus. What I mean by consensus? Well, now the successors that your client has identified and you've worked with, because you facilitated that, have participated in the process, and therefore they have input, and therefore they have approved the process. If they come out of this process and say, I was overvoted in everything, and they're going to communicate that to the staff and anybody who will listen, you got a problem. And that person should not be part of the process. And you need to find some way to get that person out of the organization, buy them out otherwise. Consensus means we've reached an agreement. We may have battled to reach that agreement, but once we've reached it, we're going to support it so that people don't think we're at each other's throats. And one of the things this bottom-up planning process facilitates for your clients is the fact that they find out whether their kids can work together. And if in fact they find out they can't work together, they still control the business and they can still do my third option, sell the business. And sometimes that can be done in such a way as the economic value, if the senior generation is already parked enough away, the economic value can be passed to the next generation, which could be good tax planning, but the senior generation can still retain control. So if these kids are going to kill themselves and therefore destroy the business, the senior generation still owns the voting stock, still owns the membership interest that vote, and therefore they control the transaction, even though they might not benefit from it economically. So they've passed wealth onto the next generation, and they prevented the next generation from blowing their wealth by imploding the company because they can't work together. 4 things that all of these plans must take into account, in my estimation. What happens if the owner dies? Is that going to be then passed on? Are they going to be bought out? Who gets it? Should you insure the owner's death? What if the owner becomes disabled, no longer able to participate? What if somebody says, I don't want to do this anymore? And obviously discord. So death is the shareholder. This is quite often the case in non-family enterprises. If a shareholder dies, we encourage the plan to provide that the shareholder who has died has to sell their stock, and the other shareholders or the entity must buy their stock, and if it can be insured, et cetera, to take the cash flow dependency out of the equation, just the better. That's not often the case in a family business. Where somebody dies, they quite often want it to pass on to the next generation. It becomes a problem when there's 3 brothers, 3 sisters, a combination in the family business. One of them dies, and now they want the family business to continue to support their family and allow their family to continue to own their share of the business going forward. So go ahead and ask your clients if they're willing to support their brother-in-law or daughter or sister-in-law for the next 20 years until their kids are old enough to participate in the business. Quite often doesn't work very well. That's why insurance is a very good way to go ahead and take that risk off the table by making sure that the deceased owner family is not at risk because they're getting insurance proceeds. Because quite often that owner doesn't think his siblings or his co-owners can run the business if he's not around or she's not around. And therefore you're taking that risk off the table. Because if you don't insure them, then they are what? Dependent upon the survivors running the business effectively for the plan to work. Disability is a function of how important a person is to the business, and the actuaries will tell you people are more likely to become disabled before reaching a certain retirement age. It used to be 65. I'm not sure people retire at that age anymore. Than they are to die. So if there's multiple owners in your enterprise, there's a very high likelihood from a statistical actuarial standpoint that one of them will no longer be able to make contributions to the enterprise. And what are you going to do about that? Are they going to be bought out? Are they going to be continued on a salary wage continuation for some period of time? If they're bought out, is there some period of time where the disability payments are in fact disability payments, and then after that they get converted to buyout payments where they're actually buying the stock? Departure, the statement I like to use is that sometimes perhaps those of you listening have been in a position where you've come home from work on a Friday afternoon, said, I don't want to do this anymore. There's got to be something more fun and more important to me than this. Maybe I should go 10 bar in Key West. We all have had that. And the question becomes, if your business partner or your sibling partner in the business comes home and tells you, I don't want to do this anymore, what are you obligated to do? Do you have to buy them out? And if you have to buy them out because they have a put, they can force you to buy them out. If they're getting out before a certain age, should that put require a percentage reduction? In other words, I'm going to buy you whatever the valuation says it is, less 25%. Instead of paying you over 60 months, like I would otherwise do, I'm going to pay you over 120 months, so it doesn't impact the cash flow of the company. A lot of factors go into this planning process that are triggered by these, what I call the 4Ds. And certainly departure, when somebody leaves and they want out, they should be restricted from competing. And I've had situations before, I've had probably 6 or 7 in my almost 50 years of doing this, where somebody gets bought out, they're subject to a non-compete, they find out after they've gotten bought out and after their non-compete ends, there's nothing else they know how to do, and they're bored out of their minds. They go right back into the business competing against the people that bought them out. It happens. Think about that. Discord. Divorce is certainly a form of discord. I used to use the term divorce, but discord is a much broader term, and a classic form of discord in my analysis is the senior owner. I'll classify myself as a senior owner who's got a 40-year-old partner, and business is going along quite well. And the 40-year-old partner wants to expand into Europe, wants to expand and build a new plant, wants to do a whole bunch of stuff, all of which requires capital. And so the 40-year-old owner wants to go to the bank and borrow a boatload of money to build a new plant, expand the business, and make it grow. What does the bank want? Unless it's a pretty big company with an awful lot of things, it's going to want a personal guarantee of the principal shareholders. I happen to be a principal shareholder. And do I want to risk my net worth on the expansion of a company that I'm probably going to be out of in the next 5 years? And I'm going to tell you right now, that prospect of risking my net worth to allow my 40-year-old to have the next best 30 years of his life frightens me. That's discord. I'm in his way or her way. And so there's got to be some way to resolve that discrepancy between us. Puts and calls are pretty simple in the context of, if I have a put, I can force him to buy me out. I want to get out. But you have to engineer all the terms of the put in advance or it doesn't work. A call is just the opposite. If I'm in the way, the minority shareholders or the younger shareholders can buy me out, force me to sell. And the only thing we're going to talk about, what's it worth? What are the terms and conditions? So what we suggest is you need to agree on the down payment. You need to agree on the number of installments. You need to accept that the interest rate will be the applicable federal rate, probably for long-term or mid-term obligations, depending on how long it is. That the seller, me, would have to agree to a non-compete. The buyer, your other clients, et cetera, are going to have to personally guarantee the obligation if I'm having to finance them to buy me out. So what haven't we agreed on? We haven't agreed on what's it worth. And that problem is the classic, because from my perspective as the senior shareholder, senior owner of this enterprise, it is a cash cow. Makes money hand over fist. I spent half the year in Florida, and this thing is really pumping out the profits. From the younger owner's perspective, Jim, you haven't paid attention to this business for years. Our equipment is obsolete, outdated. We're having a hard time maintaining customers. Our inventory is not being turned as quickly as it should be. And we have a fair amount of debt. So tell you what, I will identify and hold you harmless on the debt. We have a problem. I think it's a cash cow. My business partner who wants to buy me out or is required to buy me out thinks it is limping along and he's going to identify me in the debt. We cannot agree, so this thing doesn't work. So what the push-pull mechanism says is this. We already know what the terms of the buyout will be in terms of down payment, number of installments, interest rate, personal guarantees, etc. What we haven't agreed on is the price. So either he or I or she make an offer to the other one where we set the price. I will sell you my interest in Inc. for X. We already know all the other terms are already in place. So they can either accept that and buy me out for X, or they will sell to me for X, and I have to buy them. So whoever pulls the trigger first, wants out of the business for whatever reason, doesn't know whether they're buying or selling. They don't know whether they're buying or selling. They have to make sure that they have a reasonable price. Because if they don't, if they're asking for too much money, the other person say, fine, I'll take the money. You can't pay it. So a push-pull mechanism, the way I have just described, is a deterrent, and I have found it effective. I've used it numerous times to inappropriate puts and calls. In other words, if somebody's trying to push somebody out of the enterprise, this kind of push-pull mechanism works. Clearly, when we're talking about succession planning, we're talking about buying somebody out, someone dying, owning an interest in a closely held enterprise. What's the value? There's adjusted book value, classic adjusted book value. You all know that for accounting purposes, generally accepted accounting principles, the balance sheet has assets on it at their cost, as depreciated down, or their fair market value, whichever is lower. And most of those assets, particularly real estate, perhaps intellectual property, doesn't depreciate. It depreciates for tax purposes. It depreciates for financial reporting purposes. But for real fair market value purposes, it increases. So the adjustment for book value usually is driven by those things. Therefore, appraisals are necessary as to the fixed assets, the real estate, et cetera, to do that. Adjusted EBITDA, I think I have an example of that here. Adjusted EBITDA means gross revenue, cost of goods sold, selling general administrative expense. Selling general administrative expenses is where the owner's salary is where the rent is that the owner may be collecting, et cetera. The net income of this enterprise is $500,000. It sells at 6 times its multiple is $3 million. Now we drill down and we normalize the earnings before interest, taxes, depreciation, and amortization by adding back $200,000 of the principal owner's excess compensation. Perhaps the owner's taking out $500,000 a year, and the other owners would say, we can certainly live off of $300,000 a year, at least until we finish paying him off. They're paying themselves excess rent. Why would they pay excess rent? Well, if you're taking money out of your profitable enterprise as rent, it's deductible for tax purposes and reducing the taxable income of the enterprise. You put the $100,000 in your pocket and you pay tax on maybe 60 or 70,000 of it because it's sheltered by depreciation, which is a non-cash tax deduction. So therefore, this is a very common technique, and it's a common technique that has to be adjusted normally because quite often you pay excess. We tell people you can pay up to the maximum of the IRS tolerance, fair market value, et cetera. And there are clients, so some of you may have had clients who actually put their kids on the payroll. Obviously, when you normalize the earnings, it goes from $500,000 to $900,000, and this company is worth almost twice what it would otherwise be worth. We like appraisal mechanisms because appraisal mechanisms takes into account all of the exigencies surrounding that transaction, as opposed to formulas which can be manipulated and may not be appropriate because they were developed 5 years ago and the circumstances have changed dramatically. This, for those of you who are participating and are CPAs, we are on CPA participation code number 2. And the word that you need to record, as I understand it, is planning. All right. This is the last thing I want to cover in terms of succession planning before we get into selling a business, because as is usual, we will run out of time. This is about running the enterprise. We have spent most of this first half an hour or so talking about ownership of the enterprise. These businesses do not run themselves. So you need to sit down and talk with your client about the 3 functions he or she perform that's critical to the business. If they tell you they're performing 10 critical functions, I would suggest that you ask them, do they think that's a good thing or a bad thing? It's a bad thing, because if they're performing 10 critical functions, they are the business. That's a lifestyle business. That's not a scalable business. That business is dependent upon them. Something happens to them, death, disability, etc. The business is in trouble. They've got to learn to delegate. They can't control, touch, and feel everything. They've got to delegate. If they can't delegate, they can't grow the business ultimately, and it's going to be worth a heck of a lot less. We tell clients to try to figure out what is their highest and best use. Then do that, and then delegate everything else, because if they're doing things that somebody else can do in their enterprise, they're not getting to the things that only they can do. That's driving down the value. So if something were to happen to your client, ask them, should they hire a replacement? Should they assign the duties to somebody else? Is there management in place that can run their business? Challenge them on that, because quite often you're going to find out that there isn't. They haven't thought that through. It's called an emergency management plan. It happens. I've had clients who have died in the saddle unexpectedly. It happens. I had a client who came back. His father died when he was a freshman in college. He came back and ran the family business at 19. He ran it to 31, and we sold it at age 31 because he said, I don't want this business kill me like it did my dad. He just got married and had a couple of kids. It happens. Who should run it while the business is being sold? Because again, somebody's got to run this business. The business is going south. That's called the trailing 12 months. And if those trailing 12 months are going negative, that business is going to lose value precipitously, and you want to avoid that. Well, key customers leave. Well, key customers love you, of course, but they need to be supplied, and they're not going to stick around if they're not being supplied. And key employees, they love you and your family, your client's family, but they need a job. And if they see that the key person is no longer going to be able to deliver what is needed for this business, what do they know how to do best? What they're doing for your client. Therefore, the person who is most likely to hire them is the competitors. Management, what skills do they have? If your clients are like most of mine, true entrepreneurs, they don't have a specific discipline. They see a little bit of everything. And it's hard to find somebody who's good at all of these things. So you need to hire some of those people and deal with it and help your client come to terms with what they should do. All right, I've got 10 or 12 minutes left. My big clock here says 12:38. So let's deal with selling a business, and then we'll come back to questions. And if any of you have concerns about this, call me, send me an email. I'll be happy to talk with you about it. And one of the things I want to mention to you is that I'm doing a case study for NAPEC on June 22nd at 2 p.m. Eastern time. And some people on this webinar, I believe, probably participated through FSP in something called the Go Lucky case study. The Go Lucky case study is a family enterprise, and we have updated it, and that's what we're going to address on June 22nd. And in the context of Mr. Go Lucky has passed away. COVID got to him quickly, and he died quickly in the saddle. We've been talking about, he died in the saddle. And therefore, when he died in the saddle, it created a whole bunch of ramifications, and we're going to address those on the June 22nd at 2 p.m. Eastern time. And if you want to participate in that, I suggest you contact NAPEC, and hopefully they can help you participate. I tell sellers, if you're going to sell your business, clean it up. It's like your house. You're not going to sell your house with dirty dishes, dirty carpets, not painted, etc. You're going to make it look good. What do they call that? Putting lipstick on a pig? I don't know. I'm not saying your client's business is a pig, but dress it up. If it looks successful, it'll get more. One of the things you have to sit down with is the CPA and the client. And if they're hopefully an S corporation, because that avoids a second layer of tax, they may or may not have what is called the big tax. That's a built-in gains tax. And that could impact ultimately how much money they put in their pocket. Most transactions are going to be asset sales as opposed to stock sales. Now, what's interesting is if it is a family transaction, it probably will be a stock sale and therefore will be a capital gain. But most buyers, including private equity, which is doing most of the buying right now, are going to buy the assets, and therefore there's going to be recapture and depreciation, which gives rise to ordinary income. There's going to be hot assets, a whole bunch of stuff that are going to impact the net amount your client puts in their pocket. So a pro forma of what that might look like and whether or not they have been an S corporation for 5 years, do they have built-in gains? Are they adding property? There's a whole bunch of stuff there that needs to be taken into account. And also what the CPAs will help them do, or the valuation expert will help them do, is find out what the business is worth. If for no other reason to say, is this a good offer or a bad offer? Are we within the margin of a reasonable offer? So we should be sitting down with these people, letting them do diligence and see what we can come up with. So also help your client, the seller, determine their strengths and weaknesses. And weaknesses is like trying a case. If you have a weakness in your case, you want to bring it up. You want to get it on the table so you can explain why it's a weakness and what might be the alternatives to address that weakness versus having the buyer bring it up and now you're on the defensive. Okay? And it quite often allows the owner to correct deficiencies. Update the corporate manuals. If you have to explain how this business is run, there should be something that they can look at that would help them do that. And financial statements, we suggest that you sit down with your accountants. And if you're on so-called compilations, which is the least scrutinized financial reporting, you should at least get a reviewed statement, which means your CPA is going to take a look at it. Your CPA is going to make footnotes, which are very helpful to buyers and very helpful to buyers, financiers, to banks, asset-based lenders, etc. So you want to upgrade your financial statements if you're looking to sell your business. Normalize the earnings. That's what I just suggested. Sometimes it's called the quality of earnings. What's going through there? It is impacted by, are the kids on the payroll? Is the rent excessive? Is the payroll to the owners excessive? But more importantly, it also analyzes, are there concentrations? Is 40% of the revenue for this business coming from one customer? What are the facts and circumstances? They have a very diversified SKUs, but 60% of the revenue is coming from 4 SKUs, but they're manufacturing 50 SKUs or 1,000 SKUs. What's the quality of those earnings? Those are the kinds of things you must do. Now, I talked about cleaning it up, but this is a question you must address. Every buyer is going to ask every seller, why are you selling? And if the seller says, I'm selling because our business is in disarray, I haven't paid attention to it for years, I think our market is either shrinking or is going to disappear, so I want to get out before it gets worse. That's not a good answer. It may be the accurate answer, but it's not a good answer. So you should have a response that you can state that's accurate, believable, and supported by your facts. I'm selling one right now. The lady is in her 60s. Husband has passed away. She's done. Business is profitable. She just doesn't want to do it anymore. And she doesn't have a family to pass it to. So she's going to sell it. That's a good answer. You're going to need a team. Your CPA is going to help you throughout the entire process, but certainly it's going to help you determine what your taxes might be and therefore what you may realize net after the sale. And that should be done very early in the process, not the night before closing. Because if it's done the night before closing, they find out how much you're really going to net after the sale, they're not going to be happy. So you as the advisor need to counsel the client, find out what you're going to realize from this transaction before you make decisions whether or not to sell, what the structure of the transaction will be, etc. Financial advisor, certainly working with the attorney, the financial advisor, etc., can do certain things in preparation for the transaction, which might make it advantageous for estate tax purposes, income to the next generation, etc. The investment banker is going to give your client a perspective on what the market is for businesses like theirs and what the multiple is for businesses like theirs. And the most important thing the investment banker is going to do is find buyers. CPAs, attorneys, financial advisors, we know people who buy companies, but we're not going to send out 300 or 400 summaries, analysis of this business to potential buyers across the country. That's what investment bankers do. It's like selling your home. You don't need a realtor to sell your home. Once you have a buyer, I can do all the paperwork. I can help do everything that needs to be done, the title work, etc. What the realtor does is they find you a buyer. That's what the investment banker does. And there are a dichotomy of investment bankers. There are business brokers who are generally selling businesses that have gross revenue of $2 million or less, sometimes bigger. And then there are investment bankers, and investment bankers will sell anything, but in most cases, their minimum fee is $500,000. Do that math. What that does is that creates the business that I'm selling is in the $5 to $7 million range. You can't pay an investment banker $500,000 to sell a business with a range of $5 to $7 million. And quite often that business is more sophisticated than a business broker is used to dealing with. So they're not going to attract the kind of buyer who has the capability of buying that business. So then we have this no man's land in which a lot of us, a lot of CPAs, attorneys, some of you financial advisors operate in, because it's hard to sell that business. It's profitable, makes money. But again, the key is finding a buyer. Due diligence in the selling process. I warn clients, and I would warn you as an advisor to clients, that if you are selling your business, you're going through due diligence, you have two jobs. One, you have to continue to run your company so it doesn't fail. It's not going south during the sale process, because if it is, the price is going down. But you also have to produce all of this information. It's like a financial eminent. You know, they're going to ask for everything. And then after they ask for it the first time during due diligence, they're going to ask for it a second time when the attorneys have to prepare all the schedules. And that makes clients crazy, but that is what happens. They want analysis, they want projections. And to the extent that you are distracted or your employees are distracted, that's my bullet point C there, the value of the business could go down because in fact, there is a distraction. And it doesn't sound nice, but it's true. Try to not tell your clients' employees for as long as you possibly can. Because the moment they find out the company's being sold, they take their eye off the ball. They're not thinking about making money and keeping the business intact and keeping it valuable. They're thinking about, how does this impact me? Am I going to be out of a job? What's going to happen to me? How does this work? So we try to tell them at the very last minute. Quite often the CFO, somebody like that, has to be involved to prepare all the documents as part of the due diligence process. But to the extent that you can keep the other employees in the dark, the better, because it'll maintain the value of the business. As I said, investment bankers, they find the buyers, they do a critical assessment. They tell you what's wrong with the business, they tell you what's good about the business, and they tell you what the market is right now for your business. And you may decide, or your client may decide, let's hold off. In 21 and 22, great time to be a seller. 22 toward the end of the year got a little slow. 2023 so far is slow. There are some transactions going on for sure, but it's not going to set the kind of records it has in the past. The business process, the banker needs to understand, and will this do understand what the long-term prospects are for this company, the market it's in, its niche, etc. Profit history, if the entity has consistent profits, not like this, but consistent profits, usually that will carry a premium because they can count on that. And more importantly, the lenders who are going to give the buyer the money can count on that to amortize the debt that is going to be used to buy the business. And what are the facilities like? Are there a lot of non-operating assets? Are there things on the books that really aren't on the books for purposes of contributing to the business? Patents, copyrights, the intellectual property. Nowadays, that's very, very important, very valuable. And you have to identify it, list it, and then go ahead and determine whether or not it's going to be valuable and transferable or competitive. Also, the investment banker becomes the seller spokesperson. And sometimes we become the seller spokesperson, the senior group, when they're selling their business to their employees. The reason being, every buyer wants to pay as little as possible. So the buyer, whether it be an outside buyer or the employees, the key employees of the client that I'm talking to, are going to say what's wrong with the business. And if the owner of the business started it, they're going to really take it personally. They're going to be upset. And if they get upset, they may get so upset with the people that are working for them that they're paying that they fire them and the whole thing implodes. So we try to keep those two people apart because it's only going to be a problem. The last thing I'll cover is seller financing, then we'll take some questions, Rob. Seller financing quite often in this market with interest rates the way they are and buyers doing asset-based lending, the cost of which has gone up, et cetera. Quite often they're going to ask that the seller, in fact, finance part of the transaction. And that seller financing part of the transaction means that the seller is going to go ahead and hold a note. The problem with holding a note, it must be subordinated. It must be subordinated to the buyer's lender, asset-based lender, et cetera. And a subordination from a legal standpoint means that the holder of the note, the seller, your client, has no legal rights. The bank saying, you have no legal rights, you can't declare default, you can't force the thing into default because they still owe us money. And they owe us a hell lot more money than they owe you. And therefore you're giving up your legal rights. And we'll maybe allow you to receive interest only, but we're not going to amortize that debt until we're paid in full. So only thing your client, the seller, has in that kind of classic financing is downside, no upside. So one of the things that's been going on lately is what they call rollovers, where the seller, your client, takes a piece of the buyer's buying entity. So there's a second transaction when the private equity group, for example, sells the business in 3 to 7 years. They participate in that transaction because they have a piece. If you can get that, and you can get it into context of your client, the seller, having the right to force a sale of or purchase of his or her business, that's very advantageous. Now, Rob, I've got about 8 minutes to go. I'll be happy to take any questions, or we can keep talking about selling the business.
Jim, hello, thank you. Yeah, actually, I do have 2 questions in the queue. And then, of course, if there's time beyond that for more wisdom, we'll be open to that. The first question, thoughts on biz equity to provide a business value as a starting point.
Say that again, Rob?
Thoughts on...
I put up the final participation code for those of you who may have missed it, okay? That's the participation code, which is today's date, by the way. That 06/08/23 is June 8th, 2023. I'm sorry, Rob, go ahead.
Thank you for that. We needed it. Yeah. Biz equity as a resource to provide business value for a starting point. I'm not sure if you have any experience working with that organization.
Oh, I say biz equity is an organization, not a concept. Okay, no, I don't have any familiarity with that. There are groups growing around the country that will do a free valuation if you sign up with them to sell your business, but I'm not familiar with that particular group, no.
Okay, thank you. Next question. I work with a community foundation. Do you have any advice or point of consideration for business interests that are going to charity?
Well, there's a concept called a charitable bailout. And a charitable bailout is where an owner doesn't necessarily need the money. And so they give their business or controlling interest of their business to a charity, and then the charity sells it. And it becomes a nice way to fund a significant charitable contribution. There are some conditions there. In other words, there can't be a precondition, because quite often that charitable bailout means dad's getting out, he's transferring it to the charity, and then the charity sells it back to his family. But there can't be a precondition to make that happen, because that would be a step transaction. The IRS won't allow it. So there's a lot of different ways for a charitable organization to work with closely held business owners. Ultimately, in my experience, the charitable organization does not want to run this business, and they want to get the proceeds from its ultimate disposition. So you have to be careful how you structure it, but that would be, like I say, it's called a charitable bailout. It can be very interesting.
Thank you. Actually, there's several questions coming in related to that. Charitable interest and intent coordinated with the sale of the business. And I'm not suggesting you need to share more than what you just did, but I do want to mention there are several, particularly if there's not any succession plan, or even a potential buyer at the time to have conversations or discussions with that charitable gift officer?
Well, clearly the owner of a business, there are potentially financial advantages if their kids want to take over the business and could end up then buying it from the charity, because dad's estate is not going to pay a lot of taxes because they paid a charitable contribution of their business. But as I say, you can't have that pre-wired or it won't stand up. And then perhaps the more common method would be where the owner of the business has no successors. And so the charity can become the owner of the business. And if there is management inside the company to run the business, okay, it can become a Newman's Own kind of thing where it's the beneficiary of the earnings and profits of that enterprise. And as a matter of fact, in the Go Lucky updated case study, because he died in the saddle, his daughter and his son take over ownership. And the son has significant charitable interest and really wants a significant portion of the earnings and profits of the company annually donated to charity as opposed to left in the company for working capital, capital improvements, et cetera. And that can create a conflict. Most charities that I'm familiar with might accommodate that transaction on the basis that they don't have to guarantee any debt, they don't have any liability, and it can be run by somebody who knows how to run it. Charities don't want to own and then have liability for a business they don't know how to run. So there'd have to be a debt balance there.
Thank you. I'm going to try to get one more in as we have access to your brain and your experience. You had mentioned owners that die with the business, as if they don't have planning. Can you speak to some of the elements that you recommend in the estate planning when they own a business entity?
Clearly, and we've done this quite successfully, people like the concept of key man insurance, and it works. But if dad dies in the business and the key man insurance is in the business and payable to the business, then all of a sudden that key man insurance is subject to acquisition by the debtors, by the bank, et cetera. Quite often bank insists that there be key man insurance just for the purpose of making sure the bank gets liquidated. What we suggest is that the family members, even key employees who have an insurable interest on the owner, own the insurance outside of the business, so that if the business literally is in trouble or is going south after the owner's death, they have the option to either put the money in or not, or put some of it in or not. And if you can engineer that transaction, it gives you a lot of flexibility. And again, as I said, so quite often a lender to a closely held business will insist that there be insurance liquidity key man on the books of the entity. I'm suggesting that if you can get around that and have the insurance owned outside of the entity, then you have the option of filtering it in for working capital purposes as needed, as opposed to having a big cash hit on the balance sheet, which now becomes subject to the lender's claims.
Thank you. The questions keep rolling in. I'm going to reference what you said in the open, that if there's follow-up where they could contact you directly,
Happy to.
if you would reinforce that. Yeah, they keep coming in, and we're going to wind up here with just closing out, making sure that everybody gets their CE. As a reminder, the 3 participation codes for our accountants, the CPE codes, those will be entered or input after we conclude. You'll get an evaluation, and it'll be the last question where you'll need to put those in. For all of us, as we conclude, please consider taking a few minutes for the evaluation that will pop up. We appreciate your input. Feedback is always welcome. Thanks so much for joining us. Again, the co-sponsor of the Society of Financial Service Professionals, as well as the National Association of Estate Planners and Counsels, thanks you very much for your participation, and our conference is now adjourned.
Thank you, Rob. Thank you all.